Alrighty, well, good morning. So today I wanted to talk about what you do after you have established your emergency fund, after you've set aside enough money to cover you and all of your expenses for at least 3 to 6 months, up to a year. So ideally you don't want to just continue saving money for saving money's sake, because that money is ultimately losing value every single year. On average, 2% due to inflation. So every year the government's printing a certain amount of money into the economy, and that is lowering the value of the money by a certain amount. This year, we may see more inflation than usual. So the value of the dollar may go down much more this year. I believe it's probably going to be around 6%, but don't quote me on that. So past saving for an emergency fund, what do you do with that excess money? Once you stop saving it on the side, what do you do with it? Once you have that foundation of safety to fall back upon. So this is where investing money comes into play. And if you are not investing your money, you are actively losing money to inflation. And that goes back to the losing the 2% per year. Now that's not to say just go out and buy whatever people tell you to buy whatever I tell you to buy. Number one rule, you have to only invest in things you understand. And it's called doing your due diligence. You have to go out, read books, watch seminars, and understand what you are investing in. Because if you don't understand what you're investing in and why you're investing in it and what that is going to yield and the amount of time, then you are gambling. The difference between investing over a long period of time in something you understand and playing the lottery is statistics. It's the percentage chance of you winning. So in playing the lottery, you got 100 million chance of winning. You know, that multi-million dollars. And a lot of people think that's the only way they can get rich. But look at your chances of winning. They are so small. As opposed to investing in the stock market or investing in the real estate market or starting your own business. And don't get me wrong, if you do not understand the thing you are investing in, you are still gambling. So ideally you want to invest in things that pay you dividends, that pay you for holding that resource. And when you invest, you want to invest for the long term. Just like dieting, if you want to lose weight, you have to look at it for the long term. What can you sustain over a 20-year period? What sort of lifestyle do you want to live to work towards that goal? So if you're investing in the stock market and you don't really understand, you don't want to read the specifics about each individual company, because that's what stocks are. They are shares in a company, meaning you own part of that company when you buy that share of a company. You are a part owner of the company. Now, some stocks pay these things called dividends. There are two ways of making money from stocks. There are dividends, and then there is appreciation over time. Ideally, you would go for stocks that pay dividends. You are not guaranteed for that stock to go up and up and up over time. It can go down, it can go up. The general trend of the overall stock market is 7% year over year, but that's not guaranteed. Over a 20-year period, it has never returned a negative result. When looking at things such as index funds with the S&P 500, and now Fidelity has come out with several zero funds that you can look into. So with the stock market, generally you would want to invest in baskets of funds, which lower your risk because you are investing in a large amount of companies, but you're only buying one fund. So it makes it simpler. You can buy like the total market fund, and so these things called index funds are baskets of a whole bunch of companies. And you can buy them within a Roth IRA, so you don't have to pay taxes on that money. So it's taxed, I believe, when it's put in, and then it's not taxed when you take it out later when you're, I believe it's, I'm not 100% sure if it's 60 or 65. Well, you have to go and look at that online. But when you invest in these things and you invest for the long term, you allow your investments to compound on themselves using compound interest. So how do rich people get richer? They buy assets. Assets, like I said before, they buy stocks, they build businesses, they buy real estate. And then the money that their investments make them are reinvested into the stocks, into the real estate, into the business, and that money makes more money, and then you reinvest it again, and now you have more investments making you more money, and then you invest it again, and then you have more investments making you more money, and then it just compounds over time. So 1 becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes 16, and so on and so forth, until you have enough investments to cover your lifestyle and a little bit more to continue investing. So you will always have more wants than you have needs. And once you are able to keep your wants in check and spend only what your investments make you in order to survive and enjoy your life, that's when you are financially free. So like I said, you have to understand what you're investing in, and I will attempt to give you a list of books that you can read, or at least that I have read, in order to increase my intelligence in investing in the stock market, investing in the real estate market, down in the description. So, number 1, don't just continue saving money. Once you build that emergency fund and you've paid off your debts, your bad debts. Then you start investing money. And any bad debt is money that is compounding against you, that is becoming more debt over time, that's not making you more money. So for example, good debt could be a real estate property. You buy a real estate property on a 30-year mortgage at 4% interest, and then you rent it out. And the rent is higher than what the mortgage is per month for the tenant. So effectively, the tenant is paying down the mortgage on your house, and you're making a little bit of money on top of that. Or with the stock market, you would buy a stock after researching it and doing your due diligence and thinking in your mind that you're going to hold this stock for the long term despite the fluctuations in the market and the price of the stock. You are holding it for the long term and reinvesting those dividends to grow the amount of money you have in the stock so you can receive more dividends. So 2, think long term, invest long term. Don't sell. If things go down, you have to look at why they went down and continue to invest for the long term and be able to understand your certain risk tolerance and your time horizon for investing. If you're in an older generation and you are going to retire soon, you probably don't want to take higher risks investing in the stock market or investing in the real estate market. You probably want to lean more towards much safer, shorter term investments such as bonds that yield less percent per year but have a much safer backing to them. So for example, bonds with the US government that will issue you 3 to 4% return year over year. So these are much safer investments, but the yield, the percent increase per year is much smaller as opposed to, say, like an S&P 500 where you would be getting 7% per year or more. So yeah, hopefully you got some value out of all this crazy amount of rambling. Please let me know if I missed anything or if I should elaborate anything down in the comments. This is not financial, medical, or Aloha Spirit advice. Remember, I'm just a guy on the internet. I'm just a guy who likes to read books and randomly talk about this. Please talk with a professional before making any decisions or before just listening to me. Remember to dislike and unsub from the channel. Thank you very much for watching, and goodbye.